Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this first part, we'll break down why coal mining companies in phase-out regions may be risky investments in 2025. Let's explore how coal phase-out plans work and how they affect coal miners. Coal mining is tightly linked to environmental risk. In stricter phase-out regions, that risk can turn into large, sudden costs. Typical issues include mine cleanup and land restoration. Governments may require larger payments into reclamation funds or demand faster land repair. Lawsuits over pollution or health harms. Local communities or workers may sue over dust, water contamination, or health issues linked to mining. New rules after elections or climate events. A severe wildfire, flood, or heatwave can push lawmakers to act faster on coal. Imagine a small coal miner that expects to keep a mine open for 15 more years. If a new law forces closure in 5 years and doubles cleanup requirements, expected profits can vanish. These shocks are hard to predict from the outside and can wipe out earnings in a single year. Smaller or heavily indebted coal companies are often hit the hardest. Financing, insurance, and reputational challenges for coal companies. Money is moving away from coal. Many banks, pension funds, and insurers have no new coal policies, plans to exit coal by a certain year, or limits on how much coal exposure they will accept. Even if a coal company is still profitable today, it may find it harder to refinance old debt, borrow for new equipment or projects, or get insurance for mines, transport, and facilities. Reputational risk also plays a role. Some investors avoid coal because their clients or members do not want links to fossil fuels. This shrinks the pool of willing buyers of coal-related stocks and bonds. A smaller investor base can push borrowing costs higher, increase share price swings, and make rights issues or capital raises more difficult. For 2025 and beyond, that mix makes coal miners in phase-out regions look less attractive than many peers in other sectors. Volatile coal prices and the danger of chasing short-term rallies. Coal prices can move quickly. A cold winter, a gas shortage, or a war can send prices up for a few months. In regions that are committed to phasing out coal, these rallies often do not last. Power plants are still set to close. New wind and solar capacity is still coming online. This can trap investors. They see high coal prices, buy into miners late, then watch demand fall back as utilities shut units and renewables grow. In markets with firm phase-out dates, each plant closure removes a chunk of demand forever. Investors who care about the next 5 to 10 years, not just the next quarter, need to focus on that downward demand trend, not on short bursts of good news. How to check if a coal mining company is exposed to a phase-out region. You do not need to be an expert to spot red flags. Use a simple checklist. Location of mines and customers. Where are the mines, and where does the company sell most of its coal? Local reports and company filings often show this. Phase-out or climate laws. Has that country, state, or region set a coal phase-out date, climate law, or net zero target? Public policy sites, energy agencies, and news articles are good sources. Share of revenue from high climate target markets. How much of total revenue comes from markets with strong climate goals? A company that sells most of its coal to Europe or the UK faces different risk than one focused on markets without clear phase-out plans. Transition plan. Does the company have a real plan to move away from coal? Examples include diversifying into other minerals, investing in renewable energy, or shrinking coal exposure over time. If most revenue comes from regions with clear phase-out plans and the company has no credible shift away from coal, That is a strong warning sign for 2025. Smarter alternatives to coal mining stocks in phase-out regions. Avoiding risky coal miners does not mean giving up on energy-related investing. The same policies that hurt coal often support new areas. Looking at energy transition opportunities instead of declining coal. Many investors are turning to sectors tied to the energy shift. Broad areas to research include renewable energy companies that build or run wind and solar projects, grid and battery storage firms that help balance power supply, and businesses that improve energy efficiency such as building retrofits or efficient equipment. These areas often gain from climate laws. When governments support renewables or efficiency, the companies that supply those solutions can grow. That does not mean every stock is safe. Prices can still swing, and some projects fail. Each investor should check business models, debt levels, and time horizon before jumping in. Using diversified funds and low-carbon ETFs to spread risk. Not everyone wants to pick single stocks. Some prefer funds that spread risk across many companies. Common choices include broad index funds with low fossil fuel exposure, ESG funds that apply environmental and social screens, and low-carbon or climate-focused ETFs. Diversification means your money is spread over many holdings, so one failure hurts less. Some funds screen out coal-heavy companies or cap how much they can hold. Every fund is different. It is important to look at the fund facts and holdings list, fees and trading costs, and how strict the coal and fossil fuel rules really are. No fund is risk-free, but a diversified approach can reduce the impact of any single coal-related stock. In 2025, coal mining companies that depend on regions with clear coal phase-out plans face a rough future. Shrinking demand, tougher rules, stranded assets, and weaker access to finance all combine to make many of these stocks poor long-term bets, even when valuations look cheap. Key points to remember. Coal phase-out plans cut local demand and shorten mine lives. Climate rules and cleanup costs can erase profits without much warning. Stranded assets and higher borrowing costs put pressure on balance sheets. Short-term coal price spikes often hide long-term decline. Investors who want to protect their money can look toward cleaner, future-ready sectors or use diversified funds that limit coal exposure. By aligning capital with the energy transition instead of fighting it, everyday investors can seek returns that match where the world is headed, not where it is coming from. Thanks for watching Part 1. Stay tuned for Part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.